Hi, in this episode we're going to purely look at the financial statements of the company balance sheet, and we're going to show two things. We're going to show the increase in the holding, bank holding, CET1 core equity tier 1 capital at the bank holding, which is SOFI Technologies, and that is at the bank level. So let's look at the bank holding after March 31st, 2022. And the bank holding, you say, oh, this is good, look, we're growing the capital. That's great. We're looking at the capital. We have more CET1 capital. That's great. We are able to grow the business. Well, there's just one problem with that, because this is the paid-in capital. What's the paid-in capital? Paid-in capital is like if you issue more shares by stock options or other ways, you're going to increase the paid-in capital, and that's capital that was paid, so it enters into CET1 Basel. And what we look at that, we look at, okay, this is the cumulative increase in paid-in capital. So basically, this is the additional paid-in capital that is here, and we go here. So we look at the difference, 7.99 versus the paid-in capital at March 22. And the difference, well, what's the difference? The difference is this. We have additional paid-in capital 1.48. What is the additional total CET1 core equity tier 1 capital for Basel? 1.6. In other words, without the permanent issuance of stock, this company has no capacity to build its regulated capital, and if you don't have regulated capital, you're not going to be able to grow your loans. Forget it. So the growth in CET1 was 5.57 over this period of 1.68. So without issuing more stocks, you don't have increase. So it's basically a growth Ponzi. You need the stock market to pump. You need to pump the stock market to get the stock option exercise, and then you have a bit. But even then, it's not enough. The increase is 1.32 in loans between June 2030 to 2025 and this period. All right. Now they have been booking a gain of an additional fair value accounting 1.65 billion. That is completely disallowed for CET. So why are they doing it anyway? Because they show GAAP, which is useless for growth. They show earnings growth for GAAP, useless for growth. Why is it useless for growth? Because it doesn't count for regulated capital. And they do it anyway with the complexity of sell side. Why? Because this way they pump the stock and then they issue stock options. This is as bad as that. Thank you very much. Bye-bye.